Good morning. Let me say that again. Welcome to our first virtual retirement planning session. My name is Frances Tago, Director of Human Resources and Benefits at the Baltimore-Washington Conference. Working alongside me is Karen Conroy, the Human Resources and Benefits Administrator. This event is brought to you by our Board of Ordained Ministry and resourced by the Human Resources for our retired clergy who are over age 65. And on Tuesday, you will hear from John Garrison from EY Financial.
Ordinary life, our sleeping, eating, going to work, and walking around life, and place it before God as an offering. Eugene Peterson translates this phrase in view of God's mercies as embracing what God does for you is the you have begun every day as a gift filled with your mercies. And so remind us again and again today as we look at figures, as we consider calculations, the overwhelming abundance of your mercies that surround us, that are new every morning. Amen.
Amen. Hi, good morning, everyone. Welcome to the Clergy Retirement Planning Session. Again, my name is Bob Christoffel, and it is my pleasure to work with your annual conference for this virtual event. Obviously, all our on-site events have been canceled, so really what we're trying to do as much as we can today is duplicate those on-site efforts, replicate the program. These are today's Wespath presenters. You might have met me at on-site events previously. Peter Hang will also be manning the controls and the chat room. So if you have any questions as we go through this material, just fire away. Check the chat room because Peter will be adding value there, supplementing the topics that we talk about. And then later on, Todd has a terrific wellness program that he's going to review with you. So as always, we have a lot of material to cover. Today's program, the Wespath Retirement Plan, the Clergy Retirement Planning Session, will take us up until 11 a.m. East Coast time. And then we're going to have a short break, and I think that's important. I think a lot of people have been often when we're out there, when we're not presenting, the staff from Wespath will be holding one-on-one consultations. We've had in place since April a really terrific benefit education consultation program. There's no cost. There's no limit. We actually talked to a lot of clergy from the Baltimore-Washington annual conference over the last several months. And these are 30-minute virtual consultations where we will see you. Often we'll be in the parsonage. Maybe the spouse will be there or off camera. So we encourage you to sign up. And it doesn't have to be today or tomorrow. We have consultation slots all the way right now through December 2nd. And likely we will be extending that program indefinitely until this pandemic is over. So that's just another way that we can connect with you. So if you have any complex issues or you need help registering for benefit access, or you want us to help you run a benefit projection, I encourage you to sign up for those consultations. It'll be with either myself or Todd or Ron Theodore or our fourth benefit educator, our new guy who's actually coming up on a year, Frank O'Brien. So here's a quick overview, and I'm going to go through some of the topics quicker, some of them slower, because again, we just have so much material to cover. But what planning session wouldn't be complete with a good overview of the Wespath retirement plans? And there's a lot there. That's a pretty big section. We're going to go through all the plans, MPP, Ministerial Pension Plan, and I'll try to stay away from using a lot of acronyms as we go through the material. CRSP, Clergy Retirement Security Program, that's the plan we currently exist under. And then we'll talk a little bit about pre-82. We did check those that had registered, and I know for a fact we have at least 5 pre-82 participants on this webinar. And then what would not be complete if we didn't talk about UMPIP, and I apologize for the typo there. It's actually UMPIP, not 2 M's. Those of you that registered about 10 days before the event, you should have hopefully received a mailing, okay? And in that mailing, you'll find a benefit projection, as well as some of the other materials that we typically distribute at an on-site event. Now, Karen has also made these materials and the slide deck available on the conference website. So if you have that envelope, please have it ready, because I'll point out some of the pieces as we go through the material, including the housing allowance exclusion worksheet. So just try to have that ready. Hopefully you got that mailing. It did go out the door from Glenview, Illinois last Wednesday. So we tried to allow, because the uncertainty of U.S. mail time, but we did check with some folks and we know that those packages were arriving. We'll talk about the housing allowance exclusion as it relates to you in your retired relationship with the annual conference. Briefly, we'll go through the CPP, the Comprehensive Protection Plan. We do have a complete schedule of benefits on the conference website as well as in the mailing. A little bit more about EY Financial Planning Services. EY Navigate, the terrific website, and the Financial Planner line. Just two great tools, two great resources available to our eligible participants. And then we'll wrap it up by talking a little bit about Wespath Participant Services, including the tools like a benefit projection. This is an important one. I encourage you to run your own projections with different assumptions and different scenarios. But I would like to explain the different sections of that benefit projection and also talk about some of the assumptions that we use to encourage you to go in and run this benefit projection with your own assumptions to make it a little bit more meaningful. A couple important provisions. And usually when you get closer to retirement, you have some clarity on this. There are different types of retirement, 4 different ones outlined in the Book of Discipline. Normal is the most common. Normal retirement, age 65 or 40 years of service. Some of you might be looking at normal. The benefit projections that we sent out, one assumption is that you are looking at a normal retirement, so the date on top will reflect that. Now, if that date has already come and go, it'll look at the next July 1 after your normal retirement date. Early retirement, age 62 or 30 years of service. Mandatory retirement when you reach age 72. And there's also, you don't see it as much, but a 20-year retirement where the clergy person has 20 years of service. They've separated from the denomination for whatever reason, and they will come back at a later date to receive benefits that they are entitled to. So consider that for a moment, what type of retirement you are considering. This chart shows you all the different plans. It's kind of like a trip back in time. Some of you have been in ministry for a long time, so you will be exposed to all of these plans on this slide. We'll begin by looking at the Ministerial Pension Plan, MPP, which existed from 1982 through the end of 2006. Then we'll talk a lot about the plan we currently exist under, CRSP, Clergy Retirement Security Program, CRISP, as some participants call it. And that's an important plan. It's a complex plan. It's a hybrid, but it helps clergy with retirement income. And then we'll go back far in time to the pre-82 plan, which wasn't called the pre-82 plan at the time. It was referred to as the Minister's Reserve Pension Fund. Then off to the side, we always like to talk about United Methodist Personal Investment Plan, which is really an important voluntary plan, but it's important because you can make a significant difference in your retirement income by contributing to the United Methodist Personal Investment Plan. MPP, 1982 through 2006. When you get your quarterly statements, if you were involved with MPP, you will see that plan as an account balance. It shows up on your statement. And that's different from some of the other plans that I will talk about shortly. So MPP is a balance, and it's going to always be invested using life stage investment management service. So nobody is managing or changing or self-managing their own MPP account. Now, what makes MPP so valuable, so important, is that it truly is 2 benefits in one. It provides you with a lifetime of income, a monthly direct deposit, if you will, that you can't outlive, and if elected, can continue to your surviving spouse. So you have that security of knowing that you're not going to outlive your MPP annuity, your monthly payment. But it's also got a very flexible 35% is a cash account balance. And you can do a lot of things with that, including do nothing at first, take it out in installments, and I'll go through those different options with you. So it's really a kind of neat plan. 65% of your balance, again, becomes a lifetime annuity. And you're going to have different annuities to choose from, 6 different choices. And I will go through each of those choices because I want you to understand the choice that you made, but I also want you to understand the 5 choices that you did not make. Second important decision you'll have, and we'll talk about it, is a COLA. A COLA is a cost of living adjustment on an annual basis. It's a raise, and retirees, that becomes real important for you because of inflation, and those COLA increases can help keep up and hopefully outpace the rate of inflation. Now, the 35% on the right is that cash account balance. A lot of flexibility, a lot of different distribution options with that. And this morning, when I talk about an annuity, don't get, nervous that it's like some insurance salesman is coming to your house and he's not going to leave until you buy an annuity from him. No, an annuity here really just means a series of payments that last your lifetime and can continue, if elected, for the lifetime of your surviving spouse or other contingent annuitant. So really, and it's not going to be a monthly check. It's going to be a monthly direct deposit. But that's peace of mind, knowing that, next year, next birthday, my annuity is going to stop. Now, this 65% is a lifetime annuity. You have different choices, different annuity options. And I always want you to look at all of these different options because these decisions that you make, and you don't need to make these decisions today, but I want you to start to consider these options because at some point you will need to go on to Benefit Access through the retirement portal and select one of these. And each one of these has kind of like a price tag, a monthly amount. Now, the first 3 annuity types cover 2 people's lifetime. Often that will be a clergy and the surviving spouse. And if you're looking at this chart, you'll see different numbers and you'll see different percentages. Over here in the annuity type, you see life and 70%, life and 85%, and life and 100%. And you're asking yourself, well, what's the difference here? Well, again, it's a lifetime benefit. The difference is what percentage of your benefit will go to the surviving spouse. So if you look at this chart quickly and you want to figure out, well, what's the highest dollar amount I can get with the life and survivor annuity? That would be the life and 70%. And we don't pay out both columns at the same time. This is the amount payable to the retired participant, and this is amount payable to the contingent annuitant, often the spouse, upon the death of the participant. So under this scenario, a life and 70%, this person in this example, and this is no one's exact amounts, it's just an example of a clergy who's 65, normal retirement, and the spouse is also age 65. A life and 70% annuity, $915 per month. $915 per month, plus whatever COLA annual increase they have elected. The clergy person passes away, 70% of that amount, $641, goes monthly to the surviving spouse. And you might be looking at that number and saying that's not enough. Let me also consider the life and 85%. And you'll notice 2 things happen. The 915 goes down a little bit to 890, but the surviving spouse, the 85%, goes up to 757 a month. And you might be thinking that's not going to be enough. Let me also consider the life and 100%. That brings the amount down to 866. But this is key here. The 100%, the same amount continues uninterrupted to the surviving spouse. And these life and survivor annuities are really considered the standard form of payment for a married clergy person. If you are married and don't want to provide your spouse with a survivor benefit, you need to tell them that, and not just mention it, but you need to have them sign and consent a waiver, understanding and agreeing to give up their right to receive a survivor benefit. And then you would have the option of a single life annuity. And these single life annuities are really the standard form of payment for a married clergy person, but an optional form of payment for a married person. And if you're looking at these amounts, you might be thinking, whoa, these are higher. Bob, I like these amounts. These are much better. Yes, the reason that they're higher is because they're only covering one person's lifetime. So let's go through these because they're important. Again, 6 different annuities to choose from, 3 joint and survivor, 3 single life annuities. And the highest dollar amount here is a straight single life only, $1,056 per month in this example, plus the COLA increase. So let's say a single clergy person chooses the single life only and they live 35 years, they live until 100 in retirement. Well, good for them. They got payments for a very long amount of time, plus COLA increases for a long amount of time. Different story. Let's say a clergy person going into retirement is not feeling well. They have an existing condition, an ailment, and they choose a single life only, and 6 months into retirement, unfortunately, they pass away. The payments would cease. They would not continue to someone else. But under these next 2 options, and you'll see that there's not a huge difference in the amounts, but under these other options, you can guarantee that payments will be made for at least 5 years or at least 10 years under the 10-year certain. Keeping in mind that regardless of which option the retired clergy person chooses, it's a lifetime benefit. It's not going to end for them. But under the 5 and 10-year annuity types, it might end for someone else. So let's look at a quick example. A clergy person, single, going into retirement, not feeling well. They say, well, what am I going to do? You know, if I don't make it that long, Wespath is not going to make a lot of payments. Let me look at the 5-year certain. The amount goes down slightly, and they name a beneficiary. If the person, the retired clergy person, picks the 5-year certain, they get a little bit less per month. Let's say they live 25 years in retirement. Good for them. They die. The 5-year term is long up. But where it kicks in and becomes important, let's say they want to guarantee payments for a longer period of time. They choose the life with 10-year guarantee. They only live 7 years in retirement. They pass away. There are 3 years left on the term. Somebody, anybody they've named, and it doesn't matter if it's a brother, sister, friend, neighbor, relative, aunt, uncle, doesn't matter. They're going to get the payments, but only for the remainder of the term, 3 additional years, and then it will stop for them. So certainly a lot to consider here. Peter, I see you pop up on the screen, and that might mean that we have a question, or you just want to say hello to me.
Well, both. Good morning, everyone. I'm Peter Hang from Wespath. I've worked with Bob for a lot of years. Usually we're together at the Mission Center, presenting to you in person, and then, of course, enjoying a really wonderful lunch afterwards. But that's not the case this year. But I did want to share an answer to one of the questions. It has to do exactly what you're talking about right now, Bob. A clergy who's single, can they choose, say, a son or daughter? And on this slide for the single life annuities, like you said, if it was the life with 5-year or 10-year, they can pick anyone, son, daughter, sibling, friend, neighbor, that if they passed away before the 5 or before the 10 years, that person would get the beneficiary. If you could go back one slide, where I wanted to make a distinction is if a single clergy person were to pick one of these joint life, this has to be a spouse. Typically, again, with the child, they're going to be, 15, 20, 30 years younger, and that age of that contingent annuitant is taken into consideration. So, I mean, again, imagine a child who's, say, 20, 25 years younger is going to have a longer life expectancy, and the numbers on this page would be a lot lower. So a little bit roundabout answer to the question on the next slide, Bob. Again, the single life annuity, just like Bob said, any child, any relative, friend could be picked as the beneficiary, so that if the person picked life with 5-year or life with 10-year certain, they would get that benefit only if they passed away early. So a little bit complicated there, but thank you for that question and hope that helps.
Yeah, thank you, Peter, for jumping in with that. And one thing I'll mention just broadly, the plans that we're going to talk about this morning are intended very much to provide income to you in retirement, and continuing to your surviving spouse, income, retirement income. The plans are not specifically designed to provide income to children, but in some cases they can. And I certainly am aware of, in the event of a disabled child, that might be your intent. But if that is the case, I would suggest, if you're trying to provide income to a disabled child or even a non-disabled child, pick up the phone, give a call to EY. There might be better options available than through your retirement plans. So let's continue. The second really very important decision, you got to think about, those annuity choices, and you have plenty of time to do that before your retirement. You need to make that decision really by June 30th of the July 1, right before the July 1 that you're retiring. So keeping in mind that those decisions are not revocable. Like if you pick a joint survivor 70%, then a few months into retirement, you've changed your mind, you call up Wespath, you're not allowed to change it. Same thing with a COLA, and a COLA is an annual increase. This is a good thing, a raise in your monthly income. Now, you have in MPP, what makes it interesting, you also have a 0% COLA option to choose, but your 2% really is the default COLA. And when you go into benefit access, you'll see it's pre-populated with 2%, but you can also choose 3%, 4%, or 5%. So you might be thinking, well, this is easy, Bob. I just want the largest annual increase I can get. Put me down for that 5%. And that sounds fine, but let's look at the impact of the two extremes, the 0 and the 5%. So if you notice this orange line, that represents the 5% COLA. And if you pick a 5% COLA, it's going to bring your initial monthly income down, sometimes significantly. But a 5% increase annually is quite substantial. So over a period of time, you might start out with the lowest benefit, but there's a crossover point where eventually you could be getting the highest monthly benefit. That example before, when I talked about a clergy living to 100 with a 5% COLA, that would be a significant increase compounded in their income. And then you think about, well, what about a 0% COLA, Bob? I don't really want an increase, but I do want a higher benefit right now. That's this red line here. If you choose a 0% COLA, you're going to get a significantly higher benefit, but it's going to remain flat. And you might start off with the highest benefit, but eventually you'll reach a point in time where you could be receiving the lowest monthly benefit, but you did get to enjoy sometimes hundreds of dollars a month more for many, many years. Again, the default, the one we see chosen most often, is this pink line representing a 2% annual cost of living adjustment. So that's just an important consideration. So let's wrap up MPP here and move on. Just things to think about, like with this last year's retirement class, going out, let's say normal retirement, I would tell them, hey, you don't need to do anything with MPP right away. And sometimes people tell me, well, Bob, I do need this income right away. Or other times I'd hear, you're right, Bob. I really don't need this. I'm going to be getting Social Security shortly. I have the CRSP going. I got some UMPIP. I'm going to wait. Now, that waiting can only go on for a certain period of time. The government eventually is going to lose patience with you and want you to start taking something out. But you can leave it on account until age 72. And it's still invested. It's still using life stage. Hopefully, it's still earning and growing. But by 72, that's when you need to start taking it out. Think about the annuity and the COLA options. Think about that 35%, because you do have the option at retirement to say, you know what, Wespath, what I'm going to do, I'm going to take that 35% now, but I'm going to wait on the 65% annuity. And again, that money would still be invested. What I see most often is the clergy person needs this income. They'll choose an annuity, they'll choose a COLA, and then that 35%, they'll roll over to UMPIP. It's the easiest thing to do. Or they also have the option to roll it over out of Wespath to another retirement plan. So a lot of different options there with MPP. Let's jump into the Clergy Retirement Security Program, CRISP. This is the plan that we currently exist under. And it is really, I think, a very special plan. It is also, I think, somewhat of a hybrid plan because it's got two different types of programs within one. It's got a defined benefit component. I like to call that DB, and also got a defined contribution component. We'll call that DC. And both of these components really make it a special plan. And the defined benefit component is a monthly paycheck that you can't outlive. It can continue to your spouse, very similar to the 65% that we discussed on MPP, the Ministerial Pension Plan. But it's also got that account balance, that defined contribution component. And that's been funded by matching contributions if you contribute to UMPIP, and also non-matching contributions, 2% of your plan compensation. So the defined contribution component of CRSP is a balance that appears on your quarterly statements. What does not appear on your quarterly statements is the defined benefit plan. And sometimes clergy will be surprised. They'll say, oh, wow, I didn't know that. You know, I'm looking at my statement and I thought that was it. No, no, no. Kind of behind the curtain is this very important, very valuable defined benefit component. Now, I always like to talk about the DB piece first. Why do I like to talk about it first? Because it's more complex. Defined contribution, balance, that's easy, flexible, it's going to be there. You don't need to do anything right away. But it's the defined benefit where you're going to need to make some important decisions, same type of decisions that you made with MPP. 6 different annuities, different cost of living adjustment, COLA options. What makes the COLA in CRSP a little different, you don't have an option for a 0% COLA. Everyone's going to get a minimum of a 2% annual increase in the clergy retirement security program defined benefit component. What makes DB and DC different? Couple of important things. Defined contribution, we said that's a cash account balance. It's invested. There can be some market risk with that. There could be fluctuations. We certainly have experienced a wild 2020 with the investment markets, the security markets, the bond and stock markets. The defined benefit piece, though, and sometimes I'll get asked, Bob, what's the balance I have in my defined benefit plan? I say, I don't know, because you don't have a balance. You have a formula. And is that a good thing, Bob? Well, I think it's a real good thing. I think defined benefit plans are valuable for participants, extremely costly, expensive for employers. I always am more concerned about participants. And what's another important component of the defined benefit piece, you have no market risk. So a lot of clergy that we did consultations with were very happy to hear that, you know, markets go up or go down, the formula did not change to calculate your benefit. And I just want to briefly explain, I don't want to get too technical, but I just want to explain. Defined benefit means your benefit is defined by math, very simple math. We multiply 3 things together, and then we divide by 12. So it's very straightforward. One of the components, the 3 multipliers, is the denominational average compensation, referred to as DAC. The DAC is the average plan compensation of clergy throughout the denomination, not just Baltimore-Washington, serving full-time appointments. And what we have seen historically, and we assume will continue going forward, is increases in the DAC every year, as illustrated by this 3-year chart of the growth of the DAC, usually about 2, sometimes 2.5% per year. So for participants retiring next year, we already have calculated what the DAC is going to be, and that's going to be $74,199. So that's one of the things we're going to multiply together when we calculate your defined benefit monthly income. Now, when you look at your benefit projections later on, or if you ever run a benefit projection, you'll see that there's 2 different lines on the top where it says lifetime income, 2 different periods of service under CRSP. Why is it broken down that way? Well, the formula changed due to General Conference of 2012, but not effective until January 1, 2014. So for the first period of service from January 107 through the end of 2013, we're multiplying 3 things together. A factor 1.25%, multiplied by the DAC at the time of your retirement, further multiplied by the years and months of service under that period of time. The example on the right, very straightforward, looking at a 2021 retirement. We talked about the DAC. That's the first thing we multiply times the factor, 1.25%, times 7 years of service. And that gives us this annual amount, $6,492. Then we get the calculator out. We say, wait a minute, pensions are not paid annually. That wouldn't be good. The retiree needs monthly income. Let's divide that by what cost of living did you choose? If you decide to go out under early retirement, which we discussed, you will receive a reduction for that early retirement. And the theory behind the reduction is you'll be getting the benefit for a longer period of time. And just a quick example, we take that full amount that we calculated for 2021, and then it's reduced by 0.5% per month or 6% per year. And in this example, the clergy person does not have the 40 years of service, or we would not be looking at a reduction at all. Now, if you're retiring just a few months short of 65, it's really not going to significantly impact your monthly benefit, but it is a reduction nonetheless. In this example, the clergy person is going out 2 years early. They're going to receive a 6% per year, a total of 12% reduction, bringing the amount down to $884 per month. So that's early retirement. And the same thing would apply to your ministerial pension plan. So that's a lot to cover. Hey, Peter, just checking in on the defined benefit component. Did any questions come to us in our chat room?
No, Bob, not specifically. I did point out about how the DAC is calculated and increases. And of course, if you're retiring next year, we already know what the 2021 DAC is, but most likely people are retiring in the future. And even though we don't know exactly what the DAC is yet, we know it increases. So we know that's going to be a higher number part of the calculation.
Exactly right. That's what we've seen historically is growth in the DAC. And I'll point that out later again to reinforce the point when we talk about the benefit projections. It is so important that that DAC continues to increase. So that's certainly a lot. Certainly the defined benefit plan, again, very valuable for our participants. Why? Monthly income that you can't outlive. Monthly income for two people. Often that's going to be a surviving spouse. So that's kind of like financial security, knowing that that benefit is not going to stop. So that's an important piece of your retirement income. And obviously in planning for your retirement, and this is true of clergy or lay employees like me, retirement income comes from different places. For clergy, there are different plans. We've seen how they've changed, how they've evolved over time. It doesn't come from just one place. Many of you will be eligible for Social Security retirement benefits as well. It's kind of like that story with the three-legged stool. You want to have different legs, different sources of income, different monthly paychecks, if you will. You want these legs, you don't want them to be loose or wobbly. You want them to be strong and steady and, in many cases, lasting your lifetime. And that'll be different than when we talk about the defined contribution type accounts, such as CRSPDC. This is a balance. This does appear on your quarterly statements. You might outlive your CRSPDC balance. You can direct the investments in your CRSPDC account, or you can choose, if you don't want to self-manage, to utilize, like about 80% of our eligible participants are doing, utilizing life stage investment management. It's available as a full cash distribution. So let's say 65, normal retirement. You need this money right now, down payment on a home or for whatever purpose. You can take it out full cash distribution. You can roll it over to UMPIP or another outside retirement plan. You don't need to do anything until age 62. That's when required minimum distributions have to be taken. I'll explain that in a little bit. Any remaining balances are paid to your beneficiary. That could be your spouse or children upon your death. So it's very straightforward. And I just want to remind you that if you get to retirement and you don't take out the DC accounts, defined contribution, including CRSP, it doesn't mean that the money is frozen, sitting idly and doing nothing. It is still very much active and invested, either self-managed or through life stage. So those are the two really important components of that CRSP. And I know we've gone through a lot of information. You know, we talked about MPP as a balance, 65% becomes annuitized, 35% cash account balance. CRSP, those important choices for the defined benefit, the annuity types, the COLA increases, what to do with the DC. Now we'll go back further in time and give you a brief explanation of the pre-82 plan. And some of you, I realize, do not have a pre-82, but it's fairly straightforward. You don't have all these different annuity choices. Each annual conference has set decisions for you in regard to the pre-82 benefit. What we'll do at Wespath, what our obligation is to calculate your pre-82 benefit two different ways. You have what's called DBSM, defined benefit service money, which has been invested for you for a very long period of time. If you have pre-82, you know, I thank you for your service. It is just always amazing to me when we do on-site workshops or even during virtual webinars that we still have a lot of clergy with pre-82 benefits coming. Just a very long time in ministry, and I thank you for that. Really special. So we look at that DBSM money, see what it's grown to, and then we convert it to an annuity based upon different factors. But we also will calculate a very straightforward defined benefit formula benefit where we're looking at mathematics. Now, what we'll always do is give you the benefit which is the higher of the two calculations. This is also a lifetime benefit. This also will continue to your surviving spouse. The two different ways, we have an example here of the calculation. Let's say a clergy person has 5 years of pre-82 service. Every year at annual conference, you vote on a past service rate. For your conference, it's $768 per year in the example. So we multiply 5 times the 768, and we get an annual benefit. We divide that by 12 to get a monthly benefit. In this example, and this is just an example, it's $321 per month. But then, so we hold that number, and then we say, all right, now we've got to look at the DBSM, defined benefit service money, and let's see how that converts to an annuity. Okay, we do the math, and it comes out to $4,212 annual benefits, so bigger. Divided by 12, 351, still bigger than 320. So what we do at Wespath, we don't call you up and ask, which do you want? We're automatically going to give you into a Clergy Benefit Academy. I typically will do a class called Making a Difference. And that's all about UMPIP. And sometimes that class can be 90 minutes long, sometimes 75 minutes. We're going to do a very condensed explanation of UMPIP because I don't want you to think it's too late. It's not too late to contribute. It's not too late to contribute a lot to UMPIP. I've talked to a lot of clergy over the years that have told me, hey, Bob, I went to one of your seminars a few years ago and I started putting in more money, and now I've retired 4 years later and I have a much higher balance. What does that mean to me? Higher monthly income potential from UMPIP. So take full advantage of your opportunities to contribute. There's a lot of flexibility with UMPIP. It's a DC defined contribution plan. The only way to get money into UMPIP is through automatic payroll deduction. Most of you are probably using life stage. Some of you, though, might be self-managing your own investments, choosing those investments, coming up with an asset allocation, making changes occasionally. So those are the two different ways to do it. Totally up to you. What are the social governance? Wespath, really, we manage a lot of money in a very sustainable, socially responsible fashion. Now, different ways to put money in, and I still want you to think about this. You might have made this decision a very long time ago, but I always ask at the Clergy Benefit Academy, you should know, you should be able to tell me, Bob, I'm putting in 4% and it's going in pre-tax, or I'm putting in 6% and 2% Roth, 4% before tax, and I'm using life stage, and I have moderate risk tolerance and 67 as my benefit commencement date. So you should, if you haven't thought about this for a while, think about two things. How much am I contributing? And how am I contributing that money to UMPIP? Different ways to do it. You can maybe want to avoid paying taxes right now with before tax contributions, or maybe, just maybe, you want to avoid paying taxes later, and we have a provision after tax plus, very important, a Roth component to this plan. The plan is portable. It also accepts rollovers if you came to ministry late or had a previous career where there was a 401k or a 403b plan. Rollovers just speaks to the portability, moving money from one plan into UMPIP. And this plan, like most plans, does accept rollovers. So here are the 4 different ways how I can get money into UMPIP. The most common one on my left on the screen is your before tax contributions, reducing your taxable income. Okay, dollar for dollar, whatever you put in brings down your taxable income. This is coming out of your paycheck first. Let's face it, everybody is lined up for a piece of your paycheck, and what you're doing is saying, wait a minute. First thing coming out of my paycheck is my before tax UMPIP contribution. It's growing for you year after year, tax deferred. You don't get annual 1099s. When you take it out, that's when it becomes taxable to you. But as we'll talk about later on in this webinar, could be offset by the housing allowance exclusion in your retired relationship. So there, before tax, you're avoiding taxes now. Good for you. After tax contributions, you're saying, no, I want to avoid paying taxes later on. So I'm going to take this money out of my paycheck after everything else has come out. I make this contribution. It does grow tax deferred. When I take it out, that's when it becomes taxable. Wait a minute, I've already paid taxes on it. Correct. You don't pay taxes on your contributions, but all those earnings in there, you would pay taxes on. So I always encourage participants to think about after-tax contributions last, because we added an option. Wow, I guess it's 5 years ago. We added a Roth component. And what makes Roth special or different is that it is an after-tax contribution source, and it does grow for your tax deferred. But when you take that Roth contribution out, if it's qualified, and I'll go through what qualified means, it's 100% tax-free income. We'll talk about that. And the fourth way, we talked about this portability of these plans through a rollover contribution. All these are kept as separate balances, separate sources of money on your quarterly statements. The limits are high. Sometimes I get asked, well, Bob, how much can I put into the UMPIP? And I say, well, it's a voluntary plan. You can put in anywhere from $0 all the way up to, in 2020, $19,500. Wow, that's a lot of money. In addition, if you've maxed out on what I'll call the regular contributions, the 19.5, you can set aside an additional $6,500 for a total of $26,000, including the catch-up contributions, the 50+ catch-up contributions. So certainly a lot of money. And, it's not uncommon. Sometimes I'll be doing a consultation and I'm not nosy, but I'll look at things like how much is the clergy contributing. And sometimes I'll see numbers like, wow, $2,000 a month. I say, good for you. How come you're doing that, Reverend? And they'll say, Bob, as you might know, I'm getting closer to retirement. I see the end. I see the finish line. And I realize that once I'm retired, my opportunities to contribute go away. So I'm maxing out. I'm putting in more than I even can reasonably afford because I'm catching up. I'm making up for lost time. I couldn't do it early in my career. I couldn't do it when the kids grow up and went to college, but now I can. And that's really how you can make a significant difference. And I don't want anybody to put in more than you reasonably can afford, but I do want you to think about it. And I do want you to be aware that these limits are high. And probably the last thing I'll say without beating it to death is, think about Roth contributions as well. And you might be saying, oh, Bob, I got a couple years to go. I shouldn't do Roth because of the qualification rules. Well, I say, listen carefully, because with Roth contributions, and first, I'll start off by saying, I don't know if Roth is right for everybody, but I think it might be right for some of you. And I think it's a question at least that is worth asking of a financial planner or EY. Some of you might not need tax-free income in retirement, but some of you might. So with Roth, what do I mean by qualified? What do I mean by qualified distribution from a Roth contribution? Well, what it means is that the first contribution, but not every contribution, had to be in your account for at least 5 years. And that goes real quick because it's at any point in the year to any point in the year you take it out is considered 5 calendar years, not specific to the exact date. So that happens real quick. So even if you had 3 years to go to retirement, that doesn't mean you got to take it out exactly at 65. You could wait until the money becomes qualified. So you got to be 59 and a half, or in the event that you become permanently disabled or deceased, the money is going to be qualified. So real important at least to think about. I know a lot of participants were excited back when, and Peter remembers when we added Roth.
Learning that, by knowing how much, because my spouse just asked me the other day, how much are we contributing into retirement? And I said X percent. And I was able to know that just because I had looked it up recently, but even I kind of forgot what I changed it to a year or two ago. So good advice. I just wanted to highlight that, Bob.
Yeah, Peter, thank you for that. And, sometimes I do add different things to different presentations. And, Peter and I are not clergy, but certainly that applies to us too. We should know. You owe it to yourself to know what you're putting in, how you're putting it in, and reviewing that from time to time. Thinking about it. Maybe you got an increase in compensation and you can afford more. Maybe you set this at a flat dollar amount, so it hasn't gone up with your increases in plan compensation. A lot of folks will set this at a percentage so that a bigger amount does go in as compensation increases. So it's just something good to look at. Real quick about rollovers. Again, it stresses the portability of these types of plans. It's just moving money from a previous plan into the UMPIP. And if you ever have any thoughts, concerns, you got an old statement, 2 things can happen. We do have a rollover specialist, Alira Smith-Ando at Wespath. She is terrific. Or you can also bring up this rollover question on your benefit education follow-up consultation. And we can help you look at your statements and identify and help you through the process of rollovers. A little bit about accessing your account. And I'm not going to go too deep into this, but just know, and some of you are probably familiar with it, maybe you've taken out loans. At age 59 and a half, you can do what's called an in-service withdrawal. And at 59 and a half, you might see it and say, why such a weird number? Well, the government sometimes does mysterious things, but 59 and a half is that magical age when this 10% penalty for a premature distribution goes away. So in-service withdrawals can help people. In the event of disabilities, really any separation of service, you have access to your money. And then the last one, retirement. That's what this is. It's a retirement plan. It's an additional source of retirement income. And boy, you got a lot of flexibility with how you take it out. And I stress this during our consultations and during our workshops. First choice. I always say to retirees, take care of the defined benefit stuff first. This is easy. Take care of MPP first. Think about those annuities. This is easy. Take care of CRSP first, the defined benefit piece. This is easy. And what I mean by easy, the first choice is you don't need to do anything. The money is still invested. But again, you could say, well, Bob, my situation is I do need this money right away. That's fine. You can take it out so many different ways, change your mind, unlike the defined benefit elections. You can take and maybe think about this or call EY or your financial planner. You could take, and I have seen significant balances in this plan. Good for you. You could take it out in a full lump sum distribution. You can roll it over outside. Be careful. We'll talk about the housing allowance exclusion. You could take a partial lump sum. You could say, Bob, I don't need it all, but I have promised my loyal spouse that when I retire, after 35 years in ministry, we're going to go on a great trip. And I'm going to take a couple $1,000s out in a partial distribution. Bob, we're finally buying that lake house that we really don't need this money yet. You can say, all right, I'll just take out the RMD, the required minimum distribution to keep the government happy. And we'll do that calculation for you, and we'll do it every year for you. But you got to get that money out at some point. And the good news is, because of the housing allowance exclusion, it might not be, or at least part of it might not be, subject to taxation. I'll move on, but there is a lot of good information if you really, really are interested. And I mean this sincerely, irs.gov publication 590, and it's really well written and easy to understand. It really explains distributions and the tables that we at Wespath and other institutions will follow to calculate exactly how much. So that's a lot on UMPIP. I encourage you to bring that up on our benefit education consultations, or I will, because I'll be looking at it. I'll be looking at your projection. I'll be saying, if I see a 0 there, I'm going to bring it up. If I see a 1%, I'll probably bring it up. If I see $2,000 a month, I'll probably bring it up and say, wow, good for you. But I'll also ask you, how are you putting it in? When's the last time you changed it? Things like that. Because again, that's a voluntary plan, and it can't be overstated how important it is. It's just such a great plan, and I've been a participant in it for 6 years. Wespath has a terrific auto escalation feature where every year, they'll send you a notice saying, "Hey, Bob, you enrolled in that auto escalation. We just bump you up 1%." I say, "Oh, that's right, I did." There you go. And it's just kind of a painless way to do it for me anyway. So a little bit more about investing with Wespath. We manage about $25 billion in assets. Tremendous responsibility. Really, I find it so fascinating how we invest this money. I find the investment funds in this plan to be fascinating. They're all different. They all have different securities they're going to invest in. They all have different goals they're trying to achieve. There's a lot of information available on our website, wespath.org. These are daily valued funds. Every business day that the market's open, your balances are calculated and updated. I always like to read, I guess I'm an investment geek. I like to read the fund descriptions. I call them quarterly fact sheets. It tells me what is in the fund. And fund managers are a tricky bunch. They're never going to tell you what they're doing. They're always going to tell you what they did, dated a little bit back for each quarter. On our statements, we report to you how these investments are doing. Okay, and in the investment business, you can only look back in time and measure performance, and we do that. It's very transparent. We'll also compare our investments to either benchmarks or similar investments. Hopefully, you all are getting your statements either electronically, or maybe I'm the last one getting them in the mail. They're probably going to be mad at me, but I like to get them in the mail. I like to read them. If I was at the Mission Center, I would be holding up my statement right now and showing it to you. Because I read it, I look at the investments, I look at the pie charts, I look at the balances, I look at how it's done relative to the industry averages or benchmarks. So you have that option. A lot of folks have gone online, electronic with those statements, and that's a real important thing to do for the environment, and it helps keep the cost of the plan down. But it's always good to look at those transaction details. Particularly important would be your contributions. Your conference is real good and those monies are going in, but just always, I like to look at that anyway. This basically, it comes down to 3 different ways to do this with your investments. When you're looking at your statement, you see the pie chart, and we mentioned some things. MPP, Ministerial Pension Plan, no one is self-managing that. That's life stage investment management. Some folks might understand the investments, might be able to identify their own financial goals, match it up with the goals of the funds, allocate among different funds. That's called self-managing, choosing your own mix allocation. I would not like to see anyone put all their eggs in one basket. I wouldn't want to see anybody self-managing and saying, "Bob, I'm going to go 100% stable value." Be careful with that. Okay, very conservative, maybe not keeping up with inflation. Nor would I want to see somebody saying, "Bob, I get this, I'm going to go 100% international stock fund." So be careful with that one too. Are you aware of the additional risk you pick up? You can self-manage. You can use life stage. If you're not sure, pick up the phone, call EY. If you want to consider outside assets or different plans that your spouse might even have, call EY. Different ways to do this. I did mention, and I'm included in this group. I use life stage investment management. I have completed a profile. That's the important thing. If you're in life stage, and typically at this point, if I was at the podium, I'd say, how many of you are in life stage? How many of you are self-managing? And I'd see some hands. How many of you are just not sure? And I'd see a bunch of hands too. If you're not certain, I think Peter alluded to it, you can find out easily enough. You can, if you're not sure you're in life stage, pick up the phone, call us, look at your statement, call us. Go on benefit access and check. If you're in life stage, we would like a little information from you, or we're going to have to default you to certain settings, because there's things that affect your asset allocation, your age, when you want to begin your benefits, what is your risk tolerance, conservative, moderate, or aggressive, will you really get Social Security, and when. I think the most important thing is, when do you want to begin these benefits? If you're sitting here thinking, Bob, I'm not going out until mandatory, but I haven't told anybody, I would let Life Stage know. We'll keep it between us, because Life Stage then says, hey, you have a longer time horizon. So they'll adjust your allocation accordingly. If you're sitting here saying, Bob, I know I'm going out at the first available moment, 62, let Life Stage know that as well. And this is something that you can always change. But what Life Stage does, it comes up with this allocation, this diversification to help reduce risk. And then it reviews it and it rebalances when it's necessary going forward. So sometimes you'll see transactions on your quarterly statement that you did not initiate. And that certainly could be Life Stage, just rebalancing your account for you. Very easy to update your profile. And don't feel bad about this. This could be something that maybe you were not aware of, or you've never gone in and positively changed your Life Stage profile. There's forms available to do that, but I think it's easy to go on benefit access or just give us a call, or you're going to default to 65, which might not be what you want, or you're going to default to moderate risk tolerance, and you might be very aggressive or very conservative, and that we will assume you are eligible for Social Security. So those are important factors that go into your allocation. But I think one of the most valuable features of this Life Stage investment management, there's no additional fee. This costs are paid for by Wespath, by the funds, okay, but it rebalances your account for you. And in your materials package, or also available on the conference website, is this terrific booklet, which maybe you've seen, You're on Autopilot with Life Stage. And I think that's just a great title, because that to me is what it is. Setting your account on autopilot, removing the burden of self-managing. And I know that you all are involved with very important ministries and things that you do. You might not have time. You might not just have interest in self-managing your accounts. And that's why I feel very strongly that Life Stage is just such a good service for our participants. Now, let's talk about the housing allowance exclusion. And I've mentioned it a few times. I always like to go into it, and I just want to kind of set the stage. This is just a great starting point to get you thinking about. And when you get to retirement, you're gonna have to make a bona fide, legitimate attempt to keep track of expenses. It really shouldn't be your best guess. Okay, you want to keep track of things like what's on this worksheet: utilities, furnishings, maintenance, rent, mortgage interest. Now, to sum up what the housing allowance exclusion means, I'll say it very simply. It is a tax break for retired clergy, and it's not just United Methodist Church clergy that are retired. Other denominations take advantage of this as well. You're going to get income from Wespath. Well, what does that mean, Bob? Well, we just talked about a bunch of different sources of income: UMPIP, CRSP, DBDC, pre-82. You're going to get money from different plans. It doesn't matter which one. It's income. Some of that, at least part of it, in some cases, if it's done right, maybe all of it can be excluded from taxation. But it comes down to, you got to do a calculation and look at three different numbers. And the lowest of those numbers is the exclusion. Now, the first one is easy. What is the amount designated as a housing allowance? And that comes from your annual conference. And I've only been around 6 years, but it's always, 100% of what comes out of Wespath is allowed to be excluded. Doesn't mean it will, but it's allowed to be. Second one, what is the amount that actually you expended on housing? That's where you keep track of these costs in case you're ever asked to substantiate these numbers. Third one, and this is where it gets a little tricky. What is the fair rental value of that house? And in the modest house I have here on Long Island, I wouldn't really know what it would rent for, but it's 10 minutes from the beach, and it's somebody would probably want to rent it, but I don't really know what it would rent for with maintenance and utilities and these modest furnishings, but I'll find out. And how I'll find out, often the best way to do it is working with a local real estate person. Hey, come over here and help me look around the place. I'm thinking of renting it, but I'm really not. I want you to tell me what it would rent for, and I want you to include, the furnishings. I'm just going to go to Florida and leave the house here, furnishings, utilities, and maintenance, and they'll give me a number and a letter, and that's good. That's the fair rental value of the housing. They'll look at comparables in the area, houses this size, of what they're renting for. So and this worksheet, and EY also has a great worksheet on the EY Navigate website. This is a great starting point. And I'll just give you an example or two. One is simple and one's a little more fun and interesting. Clergy person is getting $2,000 a month from Wespath. That's represented by the $24,000. They're going to spend they're spending $20,000 a year on housing because they used the worksheet and calculated this. So they got the first two numbers. They know that of the 24, the conference has designated 100% of that is allowed to be excluded, but they got to go through the math here. They get the real estate person, they come over, they say, you know what, on an annual basis, $21,000, thank you. Your work is done, because now it's easy math. You look at these three numbers here, the actual that you got from Wespath, what you spent, and what the fair rental value is. You have three numbers. The lowest is the exclusion. It can't exceed the $20,000. What does this mean? Well, it means that $4,000 is the amount that's taxable. That is a tax break for retired clergy. Another example, and this is very realistic. EY has mentioned this comes up a lot. Clergy persons approaching retirement. They got to get out of the parsonage. They're going to buy a house maybe for the first time. They got to come up with a down payment. They don't know the best way to do this. They went to a seminar, and this is an example. It's really a story, and it's not necessarily a true story, but it's a funny story of twins. Clergy A and clergy B, they're twins. They do everything identical. They make the same compensation. They invest the same way. They have the exact same balances when they reach retirement. They both go to a seminar, and one says, hey, the guy from Wespath said I could take out a partial distribution, and I'm going to do that. And this clergy over here says, I'm going to take out a $40,000 partial distribution. And what makes the story a little bit weird, maybe you've heard this, they buy houses on the same block in the same town, and they have the exact same expenses. They're getting the same money from Wespath. The only difference is how they go about the down payment for that housing. Clergy twin B says, hey, the guy also talked about the housing allowance exclusion, and he also said there's different ways to come up with this other than taking a distribution. Maybe I'll borrow money from a bank or a mortgage broker, but I'm not going to take the distribution. So make a long story even longer and weirder. When they're doing their taxes, they both get the same amount of income, $21,600 a year, $1,800 a month, but this one adds the $40,000 to it. They both have the same expenses. They both have, because they're identical houses, don't forget, the same fair rental value. But the difference, the bottom line in the story, is that clergy twin A has an amount much higher, subject to taxation, of $37,600, as opposed to clergy B that did not take that distribution. They were able to offset all of the income from Wespath. So the moral of the story here is there's different ways to approach it. Consult with EY. Sometimes retirees going into retirement, they're just not sure how much they can afford in housing. They're not sure how the housing allowance exclusion works. So have those conversations with EY or with your benefit educator on your follow-up consultation. This is just what the worksheet looks like, and it's readily available on the conference website or in the mailing that we sent out. And just keep in mind that it's available to retired clergy. It's not continuing to the surviving spouse unless they happen to be clergy as well. There was a note on the back of this worksheet that we suggest you attach to any tax return that you do, just letting the IRS know that you mean business as a retired clergy person and you're entitled to take this deduction as a housing allowance. So, and also you can refer to the section in your conference journal that references the housing allowance. So really important tax break. Can't really overstate that. It's just terrific. In your packages or available on the conference website is a complete schedule of the CPP, Comprehensive Protection Plan. There's a death benefit in the unfortunate event that an active clergy passes away. Different amounts are paid. The DAC we have referenced here. In the event of a retired clergy dying, if you are eligible to receive benefits, these are flat dollar amounts right here. And these benefits are scheduled to be increased every 4 years. So it's not just the retired clergy, it also, in the event if the spouse dies before the retired clergy, there's a death benefit there. And then ultimately when that surviving spouse passes away, or in the event an eligible child very unfortunately passes away, there's also a death benefit for that. Disability programs, very, very important. You know, in the event of a disability, you're going to have likely income needs. Access to these accounts is available to you. You can't make more money disabled than before. So there is a coordination of disability with Social Security disability. There's an application process, some periodic reapproval. But I think the most important, the most significant thing is that you do receive retirement plan credit during the time of your disability. So it's bad enough you're disabled, but you're still getting that defined benefit and defined contribution component. So I would encourage you all to hang on to and keep this in a safe place and read it through both sides, because there's a lot to this program that I'm not going to go into. Time will allow today, but it's just I think death and disability benefits are just so critical, so vital, and something that you do want to be aware of. But you do have access to your accounts, and that's important because there's going to be likely an immediate and long-term financial need. So the 35% of MPP that's not annuitized, you can access that, the entire DC of CRSP, and all of your UMPIP to help with those income needs. Always important to remind you, update your beneficiaries. Okay, easy to do. Best way to do it is right on benefit access. If your situation changed, if children have moved and they're contingent beneficiaries, go into BA and make sure that's current and make sure that's accurate. It really will let Wespath know what to do with these money, with these plans in the event of your death. And that's something you want to keep always current, both in your pre-retirement and in your retirement years. I mentioned EY. A lot of good things going on with EY. I'm going to go through this part quickly because I do want to get to the benefit projections. But I know typically when I'm out on site, I hear stories about EY. People will tell me, Bob, I've called EY. 99 out of 100 stories about EY are really positive stories. People like, and believe me, EY likes working with you. The two things I want to point out, what are most important to me: confidential. No one knows about this call. That's important. Objective. They're not selling you anything. They got nothing to sell. Okay, they're not insurance people trying to sell you an annuity or any investment product. Your call is between you and them. It is unlimited, and it's also available to you if you maintain a balance in your retired status. So, I'll go through this quickly. There was a EY booklet in your mailing, also available on the conference website. If you've never called EY, I encourage you to do so. Last thing I'll say is it's not just limited to Wespath retirement topics. It can be anything. You're buying a car. The EY Navigate website is just terrific. I have registered. I use this website all the time. I hope you take advantage of it. There's information specific to clergy and clergy that are retiring, information specific to the housing allowance exclusion. I hope by this point, you have all registered for benefit access. We have made the registration process easier than it used to be, so there's really no excuse. The day will come when you need to go on benefit access, and don't let that day be right before you're going to retire. You should be on benefit access. You should understand a little bit about where things are. It's very easy now to navigate. There are a lot of things to do on benefit access, including a benefit projection, which is a good starting point in retirement planning. You got to know how much income you're going to have, and then you can take a look at expenses to see if there is a gap between the two. And in retirement planning, as you probably know, a gap is a bad thing. You don't want a gap. But a good starting point is looking at the numbers, looking at your benefit projection. Okay, you can do this easily. You can run different scenarios, and often I'll do that for a clergy person, or they'll do that themselves. They'll say, hey, Bob, let's see what I look like at 66. But I'm also thinking of staying at 68. Let me take a look at that. And it's kind of neat because you'll see the numbers change. And I just want to point out a couple of things about this benefit projection. If you have it, in front of you, that's great. If you registered late, you're not likely going to have it, but maybe it's a tool that you've used already. It's just taking a picture at a point in time. And I had mentioned the date on top is likely going to be your normal retirement or the July 1st thereafter. It's broken down into 2 sections. You have lifetime income. Those are the defined benefit plans we talked about. You'll see 2 different rows for CRSP, the different periods of service. You'll see MPP, what that 65% annuitized will be. If you have a pre-82, it'll have that right here. It'll have a total for the lifetime benefits, and then it's going to have an account balance section. Okay, these are the defined contribution accounts. So what does that come from, Bob? Well, 35% of the MPP, your CRSP DC, defined contribution, plus your UMPIP. And you'll see monthly amounts over here, and you might be thinking, whoa, where are you getting those monthly amounts from? I didn't ask for this. Those, and it's an assumption, assume that you're using life stage retirement income to calculate how much we think, Wespath thinks, you can take out on a monthly basis so that this approximately lasts your lifetime. I would encourage you to go to page 3 of your benefit projection, lower right-hand section. You're going to see projected account balances. That's where these monthly amounts are coming from. And you could say, well, I don't want to use life stage retirement income. I don't want to do anything yet. That's fine. But take a look at those are your projected day 1 account balances. A couple of assumptions here in the projection that we mailed you, which might not be true. Normal retirement, that you will continue to make the UMPIP contributions on page 2 monthly. You might increase it or even stop it, but we assume you're going to continue that at least to your retirement. You'll see that on page 2, we have some assumptions like growth in DAC, investment rates of return. We assume if you're married, which might not be true, that you want to provide your spouse with the survivor benefit. We don't know which one. Not having spoken to you, we put life in 70%. That's something on a benefit education consultation that you could change. You could change your UMPIP contribution, change your survivor benefit, change your benefit commencement date. Peter, if you would be so kind, just to, if you have it handy, Peter, the benefit education consultation link. If you don't have it handy, I would be glad to send it out while Todd is speaking. But we do want you to sign up for these benefit education consultations. You know, I wish I was there, you know, sharing the room with you and consulting with you and maybe your spouse. But we can do the next best thing is these virtual consultations. You know, it looks very much like this. You know, I'll pretend I'm Bob. Well, I am Bob. Peter will pretend he's clergy, and we're doing a consultation. I say, oh, Peter, I got your projection up here. Let me show it to you. And you want to run a different one, or maybe I'll help you register for benefit access. Peter, I know I covered a lot of material, and we're just coming up on our scheduled break. Did any questions come in?
There were a lot of questions, Bob, and I've been answering them in the chat. Hopefully, I haven't been talking too much. I'm kind of like the 2 guys in the Muppets who sit in the corner and just make comments at the presentation the whole time. But hopefully, they were good informational comments. I did want to mention also, Bob, like you said, when you look at your individual retirement projection, if it says married and you're single, or if it says single but you're married, sometimes we don't have the most up-to-date information. Bob, I know you and I have sat down with a clergy and maybe a spouse or a single person, and the marital status is wrong. And so that's obviously something, whoa, we need to take care of now. So check that over. And again, I just want to reiterate your comment about beneficiaries. You know who your kids are, who you want to have listed, but sometimes we don't have the most up-to-date information. And because a beneficiary form supersedes a living will, it's important to have that updated. So again, if you're not sure who's listed as your beneficiary, call us up. We can tell you once you verify yourself, or you can look it up on Benefits Access. And if it's who it's supposed to be, then great, you have that peace of mind. If it's not, oh, I need to get that updated. Or a lot of times people say, you know, my son or daughter's moved, they have a new address. Maybe my daughter got married, has a different last name. Those are all things we want to have the latest and greatest up-to-date information. So in your then if you're passing and monies need to be paid to your beneficiaries, we want to make sure it goes to the right person.
Yes.
Or persons.
And typically, exactly, that's what I've seen as the most common not up-to-date information has to do with children, children's last names, and children's addresses. We'll find them, but please let us know. That would be great. I think we're just 1 minute behind, but please, we have a scheduled 15-minute break. Try to get back at 11:15 East Coast time, and then we'll pick it up with Todd and continue. We'll continue to monitor the chat room, and I give you my thanks for participating in this. And there's Todd. He'll join you at 11:15. But get up, stretch, clear your mind, get a cup of coffee if you want. We'll see you at 11:15.
Great job, Bob.
Thank you, Peter.